And welcome, Luca. Welcome to our digital edition of Tech Insight, which is the first one we held in digital, and we are very happy to have you here. And I just want to start by asking you the first question, which is basically, you are one of the very few Italian partners in a global venture capital firm, and you started making investment out of an Italian very important family office. So how did you get there, and how is different making investment in an Italian family office compared to being one of the partners in the global digital capital firm?
Okay. Hi, Max, and hi, everybody. Thanks again for having me, and I hope we will have an insightful session all together today. Yeah, maybe, as you mentioned, right, my segue into venture was not exactly the usual one. I started my career in venture through H14, an important Italian family office, and of course, being very grateful for the fact that they gave me a lot of trust and a lot of opportunities to really craft my own strategy within a traditional place that we will not expect people where to groom when it comes to this industry. I think what I've learned from that early days was very much around being an independent thinker. So I didn't have a brand to leverage when it comes to venture. I didn't have a track record. I didn't have a network to pull into. So I really had to prioritize, brutally prioritize, I have to say, which sectors, which teams, which entrepreneurs to really chase and go after. And I think having the benefit of being an outsider it really forced me to work hard on those core companies of being an independent thinker. So that was somehow the first step that I will recall of those days. Then it's been a lot about proving myself with entrepreneurs, really trying to demonstrate that I could have, as an individual and us as H14 as a team, really a reason to exist for them and a reason to be considered from them. Because of course, good entrepreneurs always have alternatives to segue into fundraising and raising capital. So I've done that by helping them and really being trying to demonstrate them that I could have been a good partner in their developments from a company perspective, regardless of being at the super early stage or a bit more advanced stage. And by doing so, you really get into a flywheel of really leveraging a bit of experience and a bit of reference that people can say about you and about your firm. And that flywheel brings you to usually other entrepreneurs, other co-investors, and other participants in the market ultimately. So by doing that, you create a bit of track record and a name for what you're doing. And that, in short, really very much allowed me to scale toward the years and get where I am. Of course, building a good portfolio helped, I have to admit. But at the end of the day, it was very much around really creating a positive relationship with entrepreneurs, having an impact and having good reference that came out of them. And back to your point, Max, how does it differ? So I think does it differ from the fact that now I'm in a global platform. Of course, being with a global platform comes with a lot of advantages in terms of network you can leverage, a broader team and a broader set of expertise that have been developed over time, and a lot of lessons learned for the good and for the bad of companies that have done some mistakes or companies that have done incredibly well. So those things, of course, I didn't have access in my previous job, but ultimately the job is the same. So it's about leveraging maybe a few nuances and few powerful addition in your toolkit, but the job didn't change that much, I have to say.
No, it's very interesting. And you said one very important thing to me, which is independent thinker, which I can translate also into critical thinker. But sometimes if you look at the industry from the outside, so we always think of ourselves as independent and critical thinker. But if you look at the trend from the outside, sometimes you feel like all the VCs are following mainstream trends. And so how do you strike the balance between being an independent thinker and being there and the fear of missing out when there are deals in certain vertical which become mainstream?
Yeah, that's a very good question, Max. What I meant by the independent thinker was exactly going that direction, right? I think this industry has historically been very much look at the outside as an industry that is following trends that are obvious. But you know this well as a venture capitalist, as unfortunately there are not that many obvious trends at the time we're investing. So what I meant by being an independent thinker is really do your homework, do somehow your research and analysis and your internal way of looking at things. Define your own thesis around an emerging trend, around your category, around an entrepreneur, around a specific product is out there. And by having developed that somehow proprietary internal view, go after companies and entrepreneurs that see the future the same way you do. And I think ultimately there's always a mix in our job of being proactive with some ideas versus being reactive what is happening in the market, because of course nobody has a crystal ball, and maybe some of your proprietary ideas or thoughts that I was mentioning might not end up being the right ones. And so you always have to listen to what is happening out there, because you might have to evolve your way of thinking. But ultimately, just being reactive, I don't think is a real good strategy. I think being reactive will take you that far or only for too little of your time, I guess. And if you do that, at the end of the day, you'll not be able to develop real depth into any category and any emerging trends that will serve you well for understanding the next trend that can happen.
That's extremely interesting, and this is something that we have been struggling with ourselves, which we try to be as early as possible in thesis of investment when we find the right person and the right entrepreneurs. But on the other side, you have this, I would say, special moment by which the venture capital industry, following the tech industry itself, has grown 10 times over the last few years. So is it still true that the basic and the pillars of the venture capital investment, so being as early as possible, being there, helping the founder scale up, is still true these days, while the industry has grown so that much time, and also involving in this industry investors that weren't there before, and so how the impact of those investors are changing a little bit the landscape?
And of course, this is $1 million question, and happy to give my own perspective. And
sure.
Of course, it's just my own, right? I intrinsically think that the essence of the industry has not changed. I think when it comes to early stage investing, at the end of the day, you do have on one side entrepreneurs or wannabe entrepreneurs that do have an idea, and they're seeking capital for accelerating the execution on that idea. But they're not just seeking capital. I think the vast majority of entrepreneurs and wannabe entrepreneurs are also seeking some sort of help. And the help, usually it is around three major dimensions. On one side, you do have the accessibility of talent. So really helping them hiring, retaining, and finding incredible people that can help them succeed or accelerate what they're doing. The second bucket that usually they do seek help, it is about leveraging a network, and the network can be different, right? So for consumer companies, can be around some important introduction that you can make to relevant people, or introduction you can make to relevant partnership. When it comes to B2B companies, it's all about business development opportunities, or again, partnership, or again, connecting with the right level of individuals that can somehow help them delivering something for a commercial or from a product standpoint. And the third dimension is about leveraging best practices. Best practices usually in our job tend to be associated with what has not worked well with something, or what has worked well with something that is comparable. Those three dimensions are something that early stage investors at different scale, at different level, can bring to the table with some specific nuances. But ultimately, I think the offering of traditional early stage investor needs to be centered around those dimensions. Then, of course, increased amount of capital has been pushing different actors to act differently than before and earlier than before. And so what maybe deeper pocket capital that are not exactly early stage investor by core are trying to do is coming earlier because they want to diversify and increase the funnel of the opportunities they want to see. But of course, these people cannot bring to the table the three dimensions that I mentioned, or at least they can, but at the level that is not relevant in the early days. So I think things have not changed that much when it comes to fundamentals. What have changed is a bit of noise all around that. And I think what has changed is that you see simply a proliferation of investors that at different stages are constantly going down the ladder. I'm sure many people in our audience must have read over the last 12 to 18 months interesting statistics about how the private market has been exploding and how fast both Europe, the US, but I would say every single country in the world really has been increasing dramatically the level of funding going into venture capital stage companies. But I think the interesting bit about those stats is that this trend is happening across different stages. It's not only about really having some mega rounds of very successful companies that are exploding. It's about really from seed to pre-IPO rounds, you're seeing a very increased level of activity. But the level of activity, it is really driven by the number of companies. The number of companies and the number of good companies particularly, it is increasing a lot. So capital usually does take note and follow. And I'm not, of course, a macroeconomic expert, and my job is not about predicting the future of economic cycles. So I don't want to comment too much on valuation and where we are in the cycle, but I want to give you the perspective that from a bottom-up point of view, the market is healthy. It's healthy because there's a lot of good entrepreneurs, a lot of good companies in number and size that Europe particularly was not able to see before. So that's why we're seeing a lot of influx of capital at all stages. And this acceleration of capital influx is bringing some distortion, as I said, but it's also good news because if anything, entrepreneurs are living in a period that is the best they could ever imagine in terms of accessibility of capital, but not only accessibility of capital, accessibility of talent and opportunities that usually were not there for them across the early stage.
No, that makes a lot of sense. And I think as we look at venture capital, if we define it like the servicing industry for technology entrepreneurs, of course, we come to see this day that the technology itself has gained much of attention in the global attention. So, in particular after the pandemic, everybody realized how healthy it is to have a digital infrastructure in place. So the country during the pandemic who were there with a digital infrastructure were able to keep up with core competences of education, businesses, and government. And all those organizations were not able to leverage on technology, they were left aside. So that was a big improvement on the awareness of the importance that technology it plays in the society. On the other side, you have the role model of the new entrepreneurs who are becoming de facto, I think now becoming a technology entrepreneur is like being an investment banker back in the 90s. Is the one thing that all the people with skill would like to do. But the point is that you clearly define where we stand in the cycle. And there is the moment A in which the venture capital was 10 times less than what it is right now. There is now the availability of capital at the macroeconomic level. So what do you think is going to be the point of the balance? So meaning that nobody is expecting a downturn. I think over time this industry will be healthy. But if and when a downturn will come, and we have experienced that back in the days, what do you think is going to happen? So the point of equilibrium is going to be like the one we are having right now, or somehow we will be bouncing back on core players in the market, design as the traditional VC are designed? I know this is maybe a $10 million question. But
yeah, indeed. And actually it's a question that at least on our side we've been posing for a long time, and we've been discussing at length also with our investors. I think, to me, back to my point about the market cycle, I don't know exactly where we are. But what I know for sure is that if we're talking about market exuberance in a way, and to a certain extent it's impossible to say the contrary. I think market exuberance doesn't last forever. But what happens usually after market exuberance cycles is that you have a return to the mean kind of adoption. And the return of the mean, in my opinion, will be in any case adapting at the level that is higher than what used to be, higher in terms of capital available in the market. And this capital available in the market at the end of the day is driven by demand and supply. The demand and supply sometimes can be somehow going in different direction. And I think effectively, maybe we're facing one of those phases. But what I told you before is that supply of capital is definitely high, but also demand of capital is very high at the moment. So the quality of companies and the number of companies has increased. So if we believe that a bit of market exuberance from a demand perspective and supply perspective will reduce over time, I have the feeling that in any case we're gonna not go back completely to what we were used to, because the market has changed fundamentally. But it's changed fundamentally because we're seeing much more innovation, faster innovation cycle, increased part of entrepreneurship talent that is coming into the market, and additional role models. In many ways, you've seen across the board in many European markets in particular, an acceleration across the level of company creation, across the level of funding received by stage, that is just in a way in early days. If you compare to the global landscape, if you compare many European hubs and many European countries against what has happened in Israel or what has happened in other countries before, you can argue that we're still early in that cycle of going in an upward direction. So back to your question, I think, yes, might be close to a top. I don't know exactly how close, but it might be. But for sure, we're not going to go back to where we were 2 or 3 years ago in terms of level of capital available in the market and size of company creation that happened across the board. And so if that happened, the question is how many players that came somehow late to this industry might have to go out. I think historically, when you have a lot of capital chasing, new part of capital chasing the same opportunities, of course, this is the fast capital that can come in, is also the fastest one that can go out.
Go away.
Yes, so I think that can happen. Of course, when you see somehow public investors that have launched many private funds that invest effectively in companies ahead of what they were used to, maybe these guys are not going to be happy in terms of the returns they're going to be able to achieve in 3 to 5 years from now. And if so, maybe they will not be able anymore to justify that strategy in light of their investors that are very different. Or vice versa, some of them might have succeeded and they want to do more. What I think will happen naturally is that you will see some level of concentration. I think is already happening across the board. You see many firms, such as the one that I work for, that has been developing across a multi-stage offering. I think the vast majority of global VC firms now do offer different products for a different stage, but effectively going from seed until very late stage and pre-IPO. I think you will see that going forward. On the other side, I think we're going to be very hard for players that are not differentiated and are just playing growth stage to survive, because they will face the pressure from the bottom and from the top. But if I have to guess, I think the more specialization should be able to give premium to early stage investors, because ultimately that's the stage where the fundamentals have not changed, as I mentioned, right? At the end of the day, an entrepreneur that wants to start a business want money, but also usually is also seeking some help. I don't think that their passive money at C stage is something that we're going to see, because it's not what entrepreneurs are looking for and should not be looking for.
Definitely. And I mean, changing the focus of the discussion into Europe. So usually, I remember talking to some US-based friends back in when we started 2013, and there was this idea that European founders has to make the suitcase, take a flight, line up in Menlo Park, and eventually being funded by one of the historical big VC firms. And recently, last week, there was the first investment of Andreessen Horowitz made as lead investor in London. So I think that those two things are really give us the perspective how has changed the landscape in Europe. And I think that your perspective, being an Italian partner into a US-based fund located in London, can, I think, give us a little bit of better visibility on how do you see this happening, this phenomenon in Europe. So it has taken really few years of development to make Europe in the map where it was not definitely 7-8 years ago.
Yeah, I think I think it took a bit more than 2-3 years, but I think now we're reaping the benefits of what has been somehow done over the last few years. So you said it right. Clearly, it used to be the case that many funders from Europe that wanted to have global ambitions were either flying to the Valley or trying to come and work with us. Accel has been effectively the first US firm having the boots on the ground in Europe in the year 2000. And if anything, over the last 20 years, we learned that, yes, we were a bit early. I think the early days of Accel in Europe were not exactly easy in terms of finding enough quality of companies that were really wanted to build the global champions. But ultimately, we were not the only one thinking that way. I think many others have followed us. And if you look now, it's not just about the example that you've said about Andreessen Horowitz doing the first seed deal in London, but it's about the vast majority of US firms that has done many deals in Europe and have actually opened up offices or hiring local teams or beefing up local teams. So if anything now, Europe has already demonstrated to being able to produce a sustainable and predictable level of incredible good companies. I think if you look, recently we produced a nice piece of analysis called Euroscape that I think is available on our channels and also on LinkedIn that showcase a bit the comparison between Europe and US when it comes to the cloud ecosystem and all the applications that are associated with the cloud developments. And what is fascinating to see is that Europe, until 3-4 years ago, was roughly 20% of the size of the US market in terms of number of unicorns, in terms of fundings that were going to unicorns. Now that ratio is more 50, 60, 70% almost, if you include Israel as well. So we have now in Europe 43, if I'm not mistaken, unicorns that have been created only in 2021, while the US has been 74. And the good news about this number is that the median value of those unicorn, the median level of capital got into the unicorn, the number of years that take that company to become a unicorn is completely the same across Europe and US. It is telling you that the world is now flat for the right amount of good companies that are somehow global players. So Europe has nothing less than the US in terms of market when it comes to funding, speed of adoption, speed of development, and anything that is associated with that. This is incredible good news. And I think in many ways, the level of acceleration, it is compounding faster in Europe than the US, of course, because we're starting from a lower base, but it's accelerating, which means that Europe and Israel together as an ecosystem have almost closed the gap already with US. And if I have to predict the future, I think in the next 2 to 3 years, you will see the funding in Europe becoming at the level of the funding in the US.
Oh, that's very interesting. And I think it happened quickly than we expected. So we have been advocating this topic for quite a long year. I remember flying back and forth to the US, but it happened very quickly. And so just to close up, I mean, where do you think that though Europe can have an angle of differentiation between the US, if there is one, or given the size of the market, we will end up looking much more similar to the US because, of course, the size matters a lot?
No, I think it's hard to say, Max, but I think Europe has definitely some areas of somehow excellence that are becoming very relevant. And I think there are 2 areas in particular in my mind. On one side, you have everything related to fintech. I think Europe has been able to create in the last few years, not only global champions, but really significant local players that have nothing to nothing less effective than the US best players. Of course, in Europe, when it comes to consumer market and opportunities, you have the difficulty of being able to craft a unified business model and value proposition that can speak to different countries, because effectively it's not a given that something that works in Italy can work in Germany or can work in the UK. And so from a consumer perspective, it's more difficult for a European company to scale across Europe than from a New York company to speak to the whole country. That's obvious. But I think when it comes to B2B, it's not the case. So I think Europe has demonstrated that when it comes to software and cloud applications associated with financial services or associated with other segments, you can create a global champion, a global viable business based out of Europe, because the level of talent, it is very high. The ecosystem has developed. You're not lacking anymore talent for the right talent for the right stage. you're not lacking anymore the right level of capital for the right stage. So I think those important building blocks are there. You do have a lot of the positive flying wheel effects of having successful entrepreneurs and seasoned executives going and funding the next layer of companies. So you have already the flying wheel happening of innovation and capital going back into the ecosystem. And you also have a lot of more stable public and private support when it comes to fostering the ecosystem from a regulatory perspective, allowing the global, so a traditional company champions to buy more technology early on, things that in Europe were not available a few years back. I think now you see a lot of that push happening, both driven by governments, but also driven by, as you said, the pandemic that forced many enterprises and many companies in Europe to fast forward the digital adoption.
Great. Luca, that was a great pleasure to have you here. Unfortunately, time is running out. I really have to thank you. I will invite you to the next version of Tech Insight. We'll hand over to Julia, who's going to be announcing the next companies presenting.